All right, I wanted to record this training because a lot of people don't seem to understand how capital flows in the world. So I wanted to record this training and just sort of explain how capital actually flows in the world and what sort of happens during periods of inflation and high rates and things like that. So basically we have two sides, right? So this is the risk off side and this is the risk on side. And everything moves always from risk off to risk on, from risk on to risk off. It's very, very simple. This is a very, very simple process. Now, there's obviously going to be some nuances here, which I'm not going to be able to cover because you'll learn them through experience. But this is pretty much how money flows in the world. So we start off anywhere along this journey. So let's take the most recent example that we have, right? 2022, everyone's in risk on mode. 2021, 2022, we're all sort of around here. There is, real estate's sort of doing well, S&P 500 doing really well, NASDAQ doing even better, Bitcoin killing it, 69,000, etc., etc. And then the world starts to go, wait a second, we got to go start moving back to risk off. So Bitcoin starts being dumped, NASDAQ starts being dumped, S&P 500, real estate is the last one, commodities was the last one, bonds, cash. This cash is the only risk-off asset, and that is US dollars. Anyone who tells you that gold, which is a commodity, is a risk-off asset is a moron, and you should immediately stop listening to them because they've never, ever been right when it comes to the flow of capital. So cash is the only risk-off asset. So what does that mean? That means that when there is a time of crisis, i.e. a market correction, a rate hike cycle, a recession, inflationary fears, etc., money from everywhere here is going to run to cash. And so that is the basis of where we're going to head to. And therefore, what you need to watch is the DXY. And the DXY is very important because the DXY will show you what's happening. Hold on a second. Can't see through the camera. Right. DXY is the symbol you need to watch because that will tell you what's happening with the US dollar and whether people are running to US dollars or not. Right. DXY, very, very important. So then all this, so now we're here. Let's say we're here. We're in cash territory, right? So you saw commodities turn off after everything else. They started breaking down to the downside. All this money was going into cash. So we're full on risk off, right? Then what we started seeing was that bonds started going up. So the bonds were going up because people started realizing, hey, maybe I don't need as much cash. Maybe inflation isn't going to be as bad as I thought it was going to be. Maybe the interest rate hikes are working, etc., etc. So I'm going to start, drip feeding a little bit from cash into bonds, right? And so that happened, right? And so now we have a situation where, and by the way, this is not an exact thing. It doesn't move in like exactly this function all the time. I'm just giving you an understanding of how capital actually flows. So then you got, bonds started going up a little bit, right? Commodities were already going up because of the cycle that we live in. And now, so commodities are going down. So the money will skip this commodities and they will jump and try to jump from bonds straight into real estate, right? This is what's sort of going to happen. The problem with real estate is that the interest rates are too high at this moment in time. So you're only going to get a few buyers of real estate, the ones that can afford to buy it. And so what will happen is, instead of stopping here, the capital will just continue into the stock market. And so this is what you got to watch out for. And that once you get into here, well, then you go into S&P 500, some dollars stop here, some dollars go, you know what, I can handle a bit more risk, and they go into the NASDAQ, which is why the NASDAQ is the further along on the risk curve than the S&P 500. And then once the NASDAQ sort of deals with what it's doing, then people go, okay, what's the thing that has the most amount of risk? Well, in our scenario, that would be Bitcoin. So therefore, Bitcoin starts going through the roof and the dollars come here. So the least amount of dollars will come here, but because of the nature of the asset class, the least amount of dollars causes the price to go up the most. So therefore, this is the highest risk, highest reward part of the curve. This is obviously, and it decreases as you go along. So you got to understand, okay, so why would people sort of skip on real estate? Well, interest rates are high. You got to be aware of that, right? Something might happen where people might skip on the S&P 500 and just focus on the tech, which is what happened during COVID. People forgot about the S&P 500 because they thought, screw the normal companies that are going to have issues. We're going to go straight for the NASDAQ. And that's why the NASDAQ recovered a lot faster than the S&P 500 during COVID. And so, yeah, this is how it goes. And then obviously once, you know, people, it's too much. Oh, my God, the dollar looks like it's going to, you know, it needs to go up because people need more dollars. Well, then the capital starts draining out of Bitcoin and going back into, you know, down this path and going towards risk off again. So this is basically what happens. This is the flow of all markets, right? You've got risk off, you flow along this way, get maximum risk on, and then you start draining to the downside back towards risk off, sitting cash, which is what we've been doing 21 and 22 pretty much, or end of 21 and 22 so far, you know, up until the summer. And now we're sort of starting to move back into this risk on category because inflation, right? Let's just write it. Inflation will be lower than what we think it's going to be. And therefore, monetary policy will need to continue to ease. So therefore, the money will start flowing back towards risk on. So this is really an interesting point of understanding how to manage a portfolio. If you're looking to manage a portfolio, what you want to do is you want to have the bulk of your portfolio sort of in the middle here, not really commodities, but sort of real estate, S&P 500, and then, you know, a smaller portion in NASDAQ and a smaller portion in Bitcoin. Depends how much you understand each asset class. Of course, that's just a traditional way of managing a portfolio. And it depends on what your risk profile is, how long you're willing to stay in the markets, et cetera, et cetera. So all of these, and also how well you deal with volatility. So that's what this is. You know, you got to be careful about how much you put into this, because a lot of people will go, okay, I can handle the risk, and they'll go NASDAQ or Bitcoin, and then the market starts plummeting, and then they want to sell like idiots. So that is really the flow that you need to watch out for. And yeah, I hope that gives you a better understanding of how capital moves. And so actually one other point, what makes money move from risk on to risk off and risk off to risk on? It's really only two things. It's interest rate hiking and inflation, right? That's it. That's really the only two things that get this to move. It is not, and that's because of the corrupt system that we live in. The fact that we live in a US dollar system is why that's the only thing. Otherwise, you would have things like market cycles, like business cycles, like current, you know, the quality of businesses, et cetera, et cetera. But because we don't, the only real two things that affect the flow of capital here or here is inflation and interest rates. And so as long as you're watching that, you sort of will have a good idea of which way capital is going to flow. So that's, you know, an understanding of how capital flows. I hope that was useful. You know, move on to the next, whatever you're looking for next, but just keep an eye out on the markets of what's going on with DXY. You know, obviously on the treasury yields and stuff like that, you want to watch the US 10-year, the US 2-year. Yeah, and obviously gold is, as far as I'm concerned at this point, irrelevant. But you know how to watch the rest of it, and you'll be able to see what's sort of going on. So that's a little bit of understanding on how capital moves from risk off to risk on.